Okay, so you want to own a credit card company, print some plastic, mail it out, charge people 22%, count the money. But here's the strange part. A credit card is the only lending product in America where the customer chooses the interest rate voluntarily, signs up for it enthusiastically, and then thanks you for the free airline miles. And it is also the business where the most aggressive, most sophisticated operators get wiped out roughly every 10 years. In the same way, for the same reason. By the end of this video, you'll know exactly how that's possible, how credit card companies actually make money on the inside, why the biggest player in the entire industry doesn't lend a single dollar to anybody, and why the customer you'd most want to have is quite often the one costing you the most. Here's the first thing almost nobody understands. Credit card company describes three completely different businesses that happen to share a piece of plastic. The first one is the network, Visa and MasterCard. They do not issue cards, they do not lend money, they own the wires between your bank and the store's bank, and they charge a toll every time something moves across them. The second is the issuer, Chase, Capital One, Discover, your local credit union. They put their name on the card, they lend you the money, and they eat the loss when you don't pay it back. The third is the closed loop. American Express does both jobs at once. Its own network, its own cards, its own credit risk. Now, which of these can you actually buy your way into? Not the network. There are effectively two of them in the United States, and they have been two of them for decades. That door is closed, so you're becoming an issuer, and that comes in tiers. The cheap version is a fintech card program. You don't get a bank charter, you rent one. You partner with a small sponsor bank, they hold the regulatory license, you build the app and the brand. $10 to $30 million to launch something real. The expensive version is being an actual bank. Your own charter, your own deposits, your own capital requirements, your own regulators living in your building. Hundreds of millions of dollars and years of approvals before you issue card number one. And then there's the cost nobody warns you about. Geography. In 1978, the Supreme Court decided a case called Marquette National Bank versus First of Omaha. The ruling said that a bank can charge customers the interest rate allowed in the bank's home state, no matter where the customer actually lives. Read that again because it rewrote American consumer finance in one sentence. Every state had usury caps, limits on how much interest you could charge. After Marquette, those caps only mattered where the bank was. So in 1980, South Dakota removed its interest rate ceiling entirely and made a phone call to Citibank. Citibank moved its credit card operation to Sioux Falls the following year. Delaware passed its own version in 1981 and collected most of the rest. That is why an enormous share of American credit cards are issued from two states with a combined population smaller than Los Angeles County. You are not choosing an office. You are choosing which state's usury law you'd like to live under. Let's follow $100. You buy $100 of groceries with a credit card. The store does not get $100. In recent years, the average American merchant paid about $2.35 to process that sale. Where does that $2.35 go? The biggest slice, call it $1.70, goes to the bank that issued the card. That's interchange. A much smaller slice, roughly 13 cents, goes to the network, Visa or MasterCard. The rest goes to the processor and the merchant's own bank. Now hold that up and look at it. The issuer takes the largest piece and carries all the risk. The network takes the smallest piece and carries none. Remember that. It's the ending of this video. But here's the thing. Interchange is not where the money is. Americans are carrying about $1.28 trillion in credit card balances. The average interest rate on accounts actually accruing interest is running around 22%. 22% on more than $1 trillion. Here's the mechanic that makes it work, and it's the simplest arbitrage in banking. You take deposits. You pay depositors something in the neighborhood of 4%. You lend that same money out on cards at 22. That gap is your spread, 18 percentage points. There is no other consumer lending product in America with a spread remotely like it. A mortgage might earn you 2 points, an auto loan 3 or 4. The credit card is not a payment product that happens to charge interest. It is an extremely high-margin loan that happens to be shaped like a payment product. Now the part that breaks people's brains. Picture two cardholders. The first one spends $80,000 a year on a premium travel card. Flies constantly. Pays the balance in full every month, automatically, without fail. Never a late fee. Never a dollar of interest. The second one has a balance of about $6,500, spends almost nothing, and pays close to the minimum every month. Which one do you want? The second one. It isn't close. The heavy spender generates interchange, but you hand most of it straight back as rewards, plus lounge access, plus travel credits, plus the annual fee waivers you gave to sign them up. On a lot of premium cards, that customer is a rounding error, and on some of them, a loss. The second customer pays you roughly $1,400 a year in interest on a balance they may never fully retire. The industry has names for these too. Transactors and revolvers, and the entire business runs on revolvers. Fewer than half of adult cardholders carried a balance in the past year, and that minority produces the overwhelming majority of the profit, which explains the architecture. The minimum payment is not a convenience, it's a design decision. Set at roughly 2% of the balance, it's calibrated to be small enough to feel manageable and large enough to keep the account alive. Pay only the minimum on an average balance at an average rate, and you'll be paying for well over a decade. Automatic credit limit increases aren't generosity either. The average cardholder now has a limit around $30,000. A higher ceiling doesn't just permit more spending. It improves the customer's credit score by lowering their utilization ratio, which makes them feel more creditworthy, which makes them spend more. And the rewards program is the acquisition engine that pays for all of it. You lose money on the points to win an account that might revolve later. So the revenue model, in one sentence: balances times rate times how long they stay, minus what you give back to get them. With an 18-point spread and $1 trillion of demand, how does anybody lose? Two ways, and they arrive on a schedule. Mistake 1. Underwriting a boom into a recession. The charge-off rate is the share of balances you simply write off as never coming back. In normal conditions, it runs around 4%. Right now, it's just under that, roughly 3.8%. In the last serious downturn, credit card charge-offs went to around 10%. Now do the math on what that means. If your spread is 18 points and your losses go from 4 to 10, you just lost 6 points of an 18-point margin. A third of your business gone, without a single customer leaving. Providian was one of the largest subprime card issuers in America. It priced for risk, grew aggressively, and effectively collapsed in 2001 when the losses arrived. Advanta was a serious, decades-old card business. It filed for bankruptcy in 2009. NextCard was the first internet credit card company, and regulators shut its bank down in 2002. None of them failed because customers stopped wanting credit cards. They failed because they had already lent the money before they found out who they'd lent it to. Every credit card portfolio looks brilliant for about 3 years. Loans do not go bad immediately. They go bad on a delay, which means the exact moment your growth numbers look most impressive is the moment your risk is highest and least visible. Mistake 2. Buying customers who cost more than they're worth. In 2016, Chase launched the Sapphire Reserve with a sign-up bonus of 100,000 points and a $450 annual fee. It was a phenomenon. Applications ran so far past projections that the bank ran out of the metal cards. It also reportedly took a bite of $200 to $300 million out of a single quarter's profit. The card ultimately worked, but it demonstrated the trap perfectly. In a rewards arms race, the customers who respond fastest to a rich offer are, by definition, the customers most sensitive to rewards. And the customers most sensitive to rewards are the least likely to ever pay you interest. You can absolutely spend your way to millions of accounts. You just may have bought the wrong millions. And now there's a third clock, and it isn't a mistake. It's just the weather. In June of 2026, a federal judge granted preliminary approval to a roughly $38 billion settlement between Visa, MasterCard, and American merchants, ending a fight that has run since 2005. Interchange rates would drop by 1/10 of a percentage point for 5 years. Standard consumer card fees would be capped at 1.25% for 8 years. And the rule requiring merchants to accept every card in a network would end. meaning stores could refuse your most expensive premium card specifically. The largest retail groups in the country said the deal doesn't go far enough and would rather go to trial. Interchange funds rewards. If interchange shrinks, rewards shrink. And rewards are how you acquire the customer in the first place. 2 scenarios, real numbers. Scenario 1. The fintech card, no lending. 100,000 cardholders, average spend of $10,000 a year each. That's $1 billion of purchase volume. At about 1.7%, gross interchange is $17 million. Now give back 1.5% in rewards, because that's what it takes to compete. $15 million. You're left with $2 million on $1 billion of volume before you've paid your sponsor bank, your fraud losses, your servicing, your engineers, or your marketing. That is not a business. That is a hobby with a compliance department. If you never lend, you never really earn. Scenario 2. The real issuer. 1 million accounts, $2 billion of revolving balances. Interest at 22%, $440 million a year. Your cost of funds at 4%, $80 million. So net interest income is $360 million. Interchange, after rewards, call it $50 million. Fees, late annual, cash advance, another $80 million. Now the costs. Charge-offs at 4% of balances, $80 million. Operations, servicing, fraud and marketing, $200 million. Pre-tax profit, about $210 million. On $2 billion of receivables, that's a return north of 10%, a number that would be considered outstanding almost anywhere else in banking. Now run it once more with charge-offs at 10% instead of 4%. Losses go from $80 million to $200 million. Your $210 million profit becomes $90 million. Push losses to 12%, and you're gone. One variable, 6 percentage points. That's the entire distance between an exceptional business and a failed one, and you do not control it. The economy does. Which brings us to the ending. MasterCard, in a single recent quarter, reported about $8.6 billion of revenue and about $3.9 billion of net income. That's a net margin near 45%. It has no cardholders. It carries no balances. It does not lend $1 to anyone, and when a recession hits and charge-offs triple, it loses exactly nothing because the loss belongs to the bank. Go back to that $100 grocery run. The issuer took $1.70 and accepted the possibility of losing all 100. The network took 13 cents and accepted no risk at all. The smallest slice was the best slice. It was always the best slice. So if you do decide to get into the credit card business, remember the rule. Everybody pays the toll. Just make sure you're collecting it, not lending it.